Well, hi there. So in this video, we're going to be taking a look at Module 26, which is a little bit of stuff that you don't really need to know, and then some stuff that you really should know. So I'll try to kind of do my best where we say which stuff is okay to kind of go, oh, that's interesting, but I don't really have to store that, for the test. It's all about the Federal Reserve. So the stuff that's about the history of the Fed, I'll just kind of say, an overview of the banking system and all of that. It's interesting, especially the background of like why do we have the Fed? Why do we have these regulations? The kind of narrative is pretty cool, and the structure of the Fed. That being said, that information like the savings and loan crisis and the 2008 financial crisis, all of this stuff I think is very important for you as like a person, but less important maybe for this in terms of the class. And that I just thought I would mention this, why did the 2008 financial crisis happen and what do we do afterwards as a result? So there is some information in here though that we're going to need to know, but the big chunk of it is kind of like, it's okay if you don't. So let's go ahead and get started. Check your understanding number one. It says, what are the similarities between the panic of 1907, the savings and loan crisis, and the crisis of 2008? So this is kind of the information, again, that you don't have to know for this exam. But all of those are banking panics, right? They're all at root caused by two things, really. And like at root, they're both kind of caused by one is not enough regulation. And if you kind of go into some detail in the book, it talks about what regulations would have prevented these things from happening. And then the second one is speculation and bubbles. And so a speculative bubble, right, is one where you've bid up the price of an asset, financial asset or something else, and to the point where it doesn't really meet, what its underlying intrinsic value is. So you kind of, have real estate bubble in 2008. We have had bubbles for hundreds of years in economics, back all the way to the 1600s with something called the tulip bubble in Holland. And I encourage you to go check that out. It's interesting. But realistically, speculative bubbles and the not enough regulation is usually kind of the cause of a bad situation. Number two says, why did the creation of the Fed fail to prevent the bank runs in the Depression? And what did stop bank runs? So the first thing is you have to know what a bank run is. That's kind of like just kind of common knowledge is a bank run is when everybody lines up and tries to withdraw their money out of the bank before the bank doesn't have any reserves left to give you. And when that would happen, right, during the Great Depression, banks operated much the same way they do now, which is they lend out most of the deposits. And so they don't have your money in reserve. They have a small fraction of it. And so if a whole bunch of people start showing up and demanding their deposits, the bank has to give them the reserves, and then they run out. And when they run out of reserves, the bank has to close its doors. And before the 1930s, there was nothing to kind of ensure that you would get your money back. And so the creation of the Fed led to some regulation. In particular, it regulated something called trusts, which we don't really have as many of anymore because of the Fed. Regulation of the Fed led to some regulation, but not deposit insurance, which came later, right? Deposit insurance is the idea that if your bank goes under, right, it goes bankrupt, you will still get your money back. And deposit insurance is part of the New Deal. And so you can thank Franklin Roosevelt and the New Deal for the fact that if your bank goes bankrupt, you won't lose all of your money. And it's why bank runs don't really happen anymore. In 2008, we didn't really see bank runs because for the most part, people were kind of assured by the fact of the federal government insuring this money, they were assured that they were going to get their money back. And so that's huge, right? For regulation is an important piece of keeping our financial system stable and safe. And that's a great example. Describe the balance sheet effect, describe the vicious cycle of deleveraging. Why is it necessary for the government to stop in to halt a vicious cycle of deleveraging? So this is, again, this information is kind of like ancillary to really doing well on the AP exams. But this one, the balance sheet effect is the idea that when, right, a bank's assets lose value, right, unexpectedly. So for example, if they make a loan and then the person who they lent the money to is like, suckers, I'm not paying you back. that's a problem, right? And then the asset of the loan loses its value unexpectedly, can cause the bank to become insolvent, which is a fancy word, right? When we say insolvent, that is a fancy word for the amount of their liabilities does not equal the amount of their assets anymore. And in fact, the liabilities exceeds it. And so I'm not going to write a whole bunch more down on this stuff because deleveraging is an aspect of this. Deleveraging is the problem that a lot of times they've borrowed money to make investments in other things. And some of these banks would take borrowed money and lend it out, or they would invest in stocks and bonds and real estate and things like that. And the problem is like when the value of the assets lose money, then they have to very quickly sell off some of the other assets to pay their loans, and then that makes the problem worse and worse and worse. And so this kind of vicious cycle is that when they deleverage, they sell the assets and they have to sell them very quickly, and so the value drops. Because they're kind of at the mercy of someone who's willing to buy it, and then that makes them have to sell more assets, right? And then eventually the bank goes bankrupt, and that's really bad. So you could see how that could be a systemic problem too. If lots of banks start immediately trying to sell all their assets, and there aren't that many people on the other side of the deal who are willing to buy, then the assets drop in value a lot really fast, and it becomes this vicious cycle, as they call it. All right, we're going to take a look at these multiple choice questions. So the first one says, which of the following contributed to the creation of the Fed? For this one, you don't expect it to appear on the quiz. It is the bank panic of 1907, in fact, so it's A only. That there's a really interesting story about it, and it's the idea that this banking financial crisis was only stopped because of really the intervention of one of the world's wealthiest men. At the time, his name was J.P. Morgan, and he basically stepped in and saved the financial system, which a lot of people looked at and were like, I don't know if it's totally cool to have like one dude who just because he wanted to decided he was going to use his billions of dollars to save the system. We were like, maybe we shouldn't just rely on the largesse of billionaires for that. So that's where it kind of came from. And it still didn't really solve the problem. There was a 4-year-long recession after that. So like even with JP Morgan intervening, it created a whammy for the US economy. Number 2, which of the following is part of both the Fed and the federal government? Again, this is a question that you don't really need to know for this one. And I would say A, the Federal Reserve Board of Governors. It's basically part of the Fed and the actual government portion of it. Number 3, which of the following is not a role of the Federal Reserve System? This is a question that you might see on an exam because it's really what do central banks do? So on an exam, it's more likely you'll see questions about central banks, particularly an AP exam. But in this case, it's the same idea. So controlling bank reserves is kind of an aspect of what they do, but controlling it is a little weird. That word is a little bit too strange for us. Really, banks get to control their own reserves. B, printing currency. They don't really print the Federal Reserve notes. And so I'm kind of right now in between A and B. I'm leaning towards B because they don't really print them. They hire the government to print them. Carrying out monetary policy, they obviously do that. Supervising and regulating banks, they definitely do that. And holding reserves for commercial banks, I like that answer better than A. But I think that B is the correct answer here for this one because they don't actually print the money. They decide how much to create, but they place orders for how much to print. But I will go back and kind of double check this one because I'm really kind of on the fence about A and B. And what I'm going to do is I'm going to change A so that even if it is supposedly the right answer according to the textbook here, that it's very clear like which one of the things that's not theirs. And I'll line that up with the 5 things I said in class. Number 4, who oversees the Federal Reserve System? Let's see, it's not that, well, it's sort of the presidents of the Fed. It's sort of it's best to say the Board of Governors, D. Again, this is not a question you should expect to see. So this section is a lot more about like how does the Fed actually work, which is fine. But which of the following contributed to the financial crisis of 2008? Subprime lending did. Securitization, that's when they package a bunch of them together. Deleveraging, low interest rates leading to the housing boom. That's probably why. But I'm sure that want us to say is E, all of the above. Okay, let's do free response number 2, and we'll be on our way. What does the Board of Governors of the Fed system do? They regulate the financial system. Like that's really their prime function is they regulate the financial system and set monetary policy. That's their biggie, right? Monetary policy. That's what they do. They set the policy. B, who appoints the members? The Prez. See, how long do they serve? I want to say they serve 7-year terms. Again, this is not test bait. You're not going to get a question like that. Why do they serve a term of this length? Political interference, or to avoid political interference. So like if you think about it, right, you set a term of 7 years, interference. The idea is that they outlast a president, right? So that you can't pack them all in if you're one president, unless you really just happen to put a bunch on. And then how long does the chair serve? I want to say that that's a 4-year term, but the idea with the chair serves a 4-year term because they rotate that job among the people who are kind of on the board sometimes. Although often the chair stays the chair for a really long period of time. It's not unusual. But I want to say it's 4, but I could go back and check. Again, this stuff not on the exam. All right, hopefully this helped you. Catch you later.